Okay, so something absolutely wild just went down in the silver market. A massive price surge got stopped dead in its tracks when the entire market was just shut down, right at the most critical moment. So today we're going to dig into what happened, why it happened, and what it could mean for the future of precious metals.
It all kicked off with this number, $54. Silver was on an incredible run, and it was just about to smash through this huge psychological wall. This was the breakout everyone had been waiting for years. You could feel the energy.
And then, literally at that exact moment, the CME's Globex platform, the electronic system where all this stuff trades, it just stopped. Poof. Trading in silver futures was halted. The whole market frozen solid, right at the peak of the action.
Now, the official story came out pretty quick. It was a technical glitch. But for anybody watching this unfold in real time, the timing was just a little too perfect to be a random accident. And that right there is the big question we're diving into. Was this just bad luck, or was this someone hitting the emergency brake to stop a runaway market?
This quote from analyst Garrett Goggin, man, it just perfectly captures the vibe at that moment. A 2% halt is a really big deal, especially in the overnight session when there aren't as many traders. The message was crystal clear to everyone watching. Something is going down. Buckle up.
So, let's get into the two competing theories for why the market came to a screeching halt. This is where the story really starts to get juicy. Okay, so on one side you have the official line from the exchange. Simple, technical glitch, these things happen, nothing to see here. But on the other side, you have a theory bubbling up from traders that this was a deliberate, purposeful halt, that the exchange pulled the plug to keep the price from going absolutely vertical.
And yeah, the skepticism from people on the inside was immediate and honestly pretty blunt. One market commentator, just Dario, tweeted out what he heard straight from a commodity trader. The feeling on the trading floor was that the whole glitch story was, well, BS.
And here's the inside scoop that explains why they were so skeptical. This trader described a market where all the sellers had just vanished. The order book was very thin. Then, one huge trade came through and basically vacuumed up every single sell order left. There was literally nobody left selling silver. At that point, the next buy order, no matter how small, could have sent the price to the moon. The halt, from this point of view, was a timeout. It gave the big players, the market makers, a chance to catch their breath, get back in there, and prevent what this trader called a price print off the charts.
So, it all comes down to the timing, right? The market is coiled like a spring. It's about to explode. And at that exact second, the system fails. And guess what happened when they turned the machines back on? Yep, the price got hammered right back down. For a lot of people, that doesn't feel like a coincidence. It feels like cause and effect.
But here's the thing. This wasn't just a silver story. It gets way bigger, because the silver halt wasn't happening in a vacuum. The entire precious metals complex was blinking red at the exact same time. And the answer to that? Not even close. When you zoom out, you see this pattern of really weird events, all suggesting the problems were much deeper than just one little glitch in one market.
All right, let's look at the case file. First, you've got the silver halt we've been talking about. At the same time, gold suddenly drops $40, not once, but twice, in what they call liquidation wicks, only to snap right back up instantly both times. And the cherry on top? COMEX, the main exchange, just fails to publish its daily data on open interest, which is something that normally runs like absolute clockwork.
This analyst, Macro Liquidity, really nailed it. He saw those crazy drops in gold and said, look, that's not real people trying to sell. That's a sign that the system itself, the market plumbing, the pipes and gears behind the scenes, is buckling under extreme pressure. And veteran analyst Alistair MacLeod pointed out the data failure. When the official exchange suddenly can't produce a basic, critical report on a day with this much chaos, it just adds another layer of suspicion. It tells you that behind the curtain, things were not okay.
So you've got all this chaos in the Western paper markets. But to really understand the pressure building up, we need to look east, because the real driver behind all this is a massive squeeze on actual physical silver.
This, right here, is the key. Physical silver stockpiles in China are now at their lowest point in a decade. We're not talking about numbers on a screen here. We are talking about the real, physical metal, and it is getting incredibly scarce.
And this timeline just shows you how that pressure is building. Right now, you have those decade-low stockpiles in China. The entire global market is already in a deficit, meaning we use more silver than we mine. And then, looking ahead,
China's announced it's going to start controlling its silver exports. It's a perfect storm for supply. And this brings us to the final and most important piece of the puzzle. This whole story boils down to a battle between two different kinds of silver, the paper promise versus the physical reality.
So on one hand, you have paper silver. Think of it like an IOU for metal. It's a futures contract traded on a computer, and its price can get pushed around by algorithms and big banks. Then you have physical silver. That's the real deal, the bars and coins you can actually hold. Its price is supposed to be about pure supply and demand. And for a long time, the paper market has been calling the shots on price, but that relationship is now being seriously tested.
This quote just nails it. The exchange can hit the off switch on the computer game. They can pause the paper contracts, but they can't stop somebody in one country from selling a physical silver bar to somebody in another. That market, the real market, just keeps on going.
And if you want to see this split between paper and physical happening right now, just look at platinum. The paper price on the COMEX in the West is trading around $1,640 an ounce. But the price for real physical platinum in China, over $1,900. That is a $300 difference. The physical market in the East is already screaming that the metal is worth way more than the paper price in the West.
And as analyst Hansa Czerny points out, this is the blueprint. This huge price gap in platinum is exactly what happens when physical demand starts to overwhelm the paper pricing game. The theory is that silver is walking down the exact same path. This isn't some far-off prediction, it's something we can see starting to happen right now.
So it all leaves us with this one giant question. We've seen the paper market can be shut down with the flip of a switch. We've seen the physical stockpiles drain to historic lows, and we can see other metals already showing a massive split between the price in the East and the West. So when the paper promise and physical reality finally collide, what is the real price? That's the question at the heart of everything right now.